Navitas Semiconductor closed its last regular trading session on Friday, May 22, 2026 at 4 p.m. Eastern Time at exactly $29.25 per share, marking a massive single-day surge of 19.98% with an absolute gain of $4.87. During the after-hour session, the stock ticked down slightly by 0.82% to settle at $29.01. The immediate market narrative suggests this dramatic upward movement is a direct validation of the company's aggressive pivot into high-power artificial intelligence infrastructure. But looking closer at the actual mechanics of this rally reveals something most retail investors are completely missing. While the headlines celebrate a monumental expansion in valuation, the company simultaneously executed a quiet dilution event tied to its old 2021 corporate structure, issuing 3.3 million new shares that effectively increases the outstanding supply. This creates a fascinating conflict where the stock is trading at all-time highs based on massive future contracts, while the near-term corporate capital structure is actively expanding behind the scenes. The general market expectations surrounding Navitas Semiconductor has shifted from viewing it as a vulnerable consumer electronics supplier to crowning it as an essential component provider for high-power tech infrastructure. The reality, however, requires a cold look at the underlying financial ratios and current balance sheet limitations. When you pull up advanced online investing tools, look at major self-investing platforms, or scan tracking resources on popular digital options like the Robinhood app, the stark contrast becomes clear. Investors are paying a premium multiple for a business that reported $8.6 million in total revenue for the first quarter of 2026. This means the market capitalization has stretched towards $6.84 billion on an annualized revenue run rate that remains exceptionally small. This creates an intense tension between what investors are buying into for the next decade versus the actual cash flowing through the business today. Let us dissect the massive trading volume and institutional momentum that drove this week's extreme price action. More than 51 million shares changed hands in a single session, far exceeding the standard daily volume of 29 million shares. A huge driver of this momentum is the heavily discussed deep integration into hardware systems designed for giant tech entities. Speculation has reached a fever pitch regarding their technology being utilized in advanced power delivery boards for high-end graphics processing units, specifically the ultra-efficient architectures required by massive operations. This has turned Navitas Semiconductor into a high-octane favorite across many modern investing sites. When retail traders log onto platforms like SoFi Invest or check their portfolios through popular services like Fidelity Investments, they see a stock that has climbed hundreds of percent since the start of the year. This intense momentum is heavily amplified by high short interest, which recently hovered around 21% of the float. When a company with high short interest releases better than expected corporate updates, the resulting short covering rally operates like rocket fuel, pushing the valuation far past what standard fundamental modeling would dictate. To understand why the sentiment is so split between institutional bears and hyper-bullish retail investors, we need to analyze the recent quarterly earnings report. The top-line figure of $8.6 million actually managed to beat Wall Street estimates of $8.18 million, which immediately triggered a wave of upward revisions from major research firms. Firms like Baird and Needham adjusted their targets significantly higher, reflecting confidence in the sequential growth guidance of roughly $10 million for the upcoming quarter. However, the bottom-line reality shows an earnings per share loss of $0.15, widening past the forecasted loss of $0.05. For an individual brokerage account holder focusing strictly on net income, a widening net loss during an epic stock rally feels completely illogical. This discrepancy is why traditional short sellers have piled into the stock, viewing the multi-billion-dollar market cap as fundamentally disconnected from a company currently burning tens of millions of dollars each year. Comment below how many shares of Navitas Semiconductor you currently hold in your portfolio right now. It is incredibly valuable to see whether our community is actively buying this high-power infrastructure breakout or standing on the sidelines waiting for the financial metrics to catch up with the valuation. If we look at the core business model, Navitas Semiconductor operates as a specialist designer of wide bandgap semiconductors, focusing heavily on gallium nitride and silicon carbide technologies. These materials are fundamentally different from traditional silicon because they can handle much higher voltages, run at significantly higher temperatures, and manage electricity with vastly superior efficiency. For years, the company relied on selling these components in the low-margin mobile and consumer electronics charging market, particularly in Asian manufacturing hubs. management recognized that competing in low-margin consumer tech was a losing proposition, so they initiated a massive structural shift to exit those legacy contracts. The immediate consequence was a significant year-over-year drop in total revenue, as the old consumer business disappeared faster than the new high-power infrastructure business could scale up. This transition explains why the trailing revenue charts look weak, while the forward-looking product showcases look incredibly robust. The underlying technology is genuinely impressive, which is why the company is drawing comparisons to major legacy players found across index funds and institutional holdings. Whether you are analyzing long-term tech trends through premium services like Interactive Brokers or managing an automated account through Schwab Intelligent Portfolios, the secular trend towards energy-efficient power management is undeniable. As modern data centers scale up to handle massive computational workloads, the power requirements are becoming unsustainable under traditional silicon frameworks. The introduction of high-voltage silicon carbide and specialized power delivery architectures allow data centers to significantly increase their power density. This means servers can draw more electricity safely without melting the physical infrastructure or requiring massive expensive cooling systems. This technical edge is what keeps the stock price anchored at premium levels, despite the fact that current financial statements show the company will likely remain unprofitable for the remainder of the year, with structural break-even requiring quarterly revenues to scale deep into the $30 million range. Looking at the competitive landscape, Navitas Semiconductor is an incredibly small player going up against massive, well-capitalized giants. When institutional managers look at the sector through a Fidelity brokerage account or build defensive positions using diversified Fidelity ETFs, they often lean towards established cash flow generators like Texas Instruments, Infineon, or ON Semiconductor. These massive competitors have billions of dollars in liquidity, their own fabrication facilities, and deeply entrenched relationships with global automotive and industrial clients. Navitas, by contrast, operates with a much leaner research and development footprint and rely heavily on external chip foundries to manufacture their designs. This asset-light model allows them to pivot incredibly fast, but it also leaves them exposed to supply chain constraints and margin pressures if global foundry capacity tightens up. The future outlook for this company depends entirely on whether reality can eventually catch up to the massive expectations currently priced into the market. There are a few clear catalysts on the horizon that investors need to watch closely. Management is scheduled to present at multiple institutional investor conferences over the coming weeks, which will provide deeper visibility into their order backlog and customer pipeline. Additionally, their recent international licensing deals, including partnerships to develop locally branded component families in expanding markets like India, show that the company is actively trying to diversify its revenue streams outside of domestic tech hubs. If these international initiatives scale up faster than anticipated, it could accelerate the timeline to profitability. Conversely, the primary risk remains the ongoing share dilution from past corporate actions and the constant threat of larger competitors replicating their wide bandgap designs at a much larger industrial scale. To bring everything together, the massive divergence between expectation and reality defines the entire trading narrative for Navitas Semiconductor. The current market expectation is built on the belief that this small chip designer has successfully secured a permanent, highly profitable position within the next generation of artificial intelligence data centers. This belief drove the stock to its record regular session finish of $29.25. The reality is a company executing an incredibly difficult corporate transformation, walking away from low-margin consumer revenue to chase high-power infrastructure contracts, resulting in a temporary revenue trough paired with widening net losses. The massive trading volumes, short covering dynamics, and aggressive price target hikes from Wall Street analysts show that institutional capital is currently willing to overlook the short-term cash burn in exchange for long-term technical positioning. For any investor utilizing modern online investing applications, managing assets via a Robinhood app, or placing trades through Interactive Brokers trading platforms, this stock represents a classic high-risk, high-reward tech play, where the technological thesis is completely solid, but the financial execution still has a long way to go to justify the multi-billion-dollar valuation. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends. Bell subscribe for more updates.